Hey, welcome investors to the 40 Finance channel. Today I'm going to be talking about Disney stock looking ahead here in 2022. Now this is a stock that fared pretty well during the pandemic, particularly with the release of Disney Plus, and at one time it saw a high close to $200. Now we've trickled down to about $140, but I'm going to throw another angle at this that I've personally been thinking about, and that is how would the reopening of the parks, the full bore reopening of the parks, meaning maximum attendance, international parks opening, the whole 9 yards, you also got cruise ships and stuff in there as well. How would that affect the bottom line EPS, and what does that mean for the long-term trajectory of Disney stock's fundamental value? So we're going to wrap all this together and make sort of a best case scenario for Disney, try to get a feel for how that might affect their stock price going forward. Okay, to start with, let's go back to when the parks were in much better shape. You didn't have to worry about closures, limited capacity, cruise ships were sailing, all the things that made Disney parks a huge part of their revenue generating machine. So this was the earnings report for fiscal year 2019. And what's nice about this is you get the comparison to 2018, so going back even further in time. And I'm just going to scroll right down to the revenue segments so that we can see how these segments were performing prior to the pandemic. And like I said, we're going to focus mostly on the parks here in this video. So in 2018, the parks as a whole made $24 billion in their fiscal year. In 2019, they ended up with $26 billion, which was a plus 6%. And you see here on the total revenues, $69.5 billion. Parks and experiences, that's basically 35% of the total pie. So when the parks went down during COVID times, no surprise that a big chunk of revenue for Disney went down as well. All right, let's just illustrate that by looking at the fiscal year 2020 report. Again, we're just going to skip right ahead to segments here. Parks and experiences, $26 billion in 2019, drops to $16.5 billion in 2020. Now, interestingly enough, total revenues you would figure would take a huge hit, right? But they did take a hit. But $65 billion down 6% from the year before, despite the fact that they lost $10 billion right here on parks and experiences. And obviously, Disney Plus and some of the direct-to-consumer stuff had a big part to do with filling the gap. Okay, one last view here, fiscal year 2021. That ended at the end of October. So we are in fiscal year 2022 now, and let's take a look at our segment results. Getting down here, parks, experiences, $16.5 billion again. It looks like they made some small changes to the 2020 numbers because I believe that was $16.2 billion. Somehow through the accounting, they revised it to $17 billion. But they landed at $16.5 billion. That was actually down 3% to 2020. So who would have figured that the 2021 fiscal year would actually do less in parks revenue than 2020? But that is exactly what happened. And remember, this is a revenue column. This is basically tickets sold. It has nothing to do with the increased cost for safety precautions related to COVID. So at $16.5 billion in 2021, they're still $10 billion short on parks and experiences compared to where they landed at the end of the fiscal year of 2019. Now, interestingly enough, at the end of 2021, they got to $67.4 billion in revenue. That's only $2 billion short of where they landed in 2019. Obviously, their streaming wins have been a big part of that. The X factor in there is we just don't know what kind of year streaming is going to have because it's comping an incredible couple years where everybody was stuck in their house. What we can do from a speculation standpoint is say, well, hey, if you're missing 10 billion on this line, if everything was running full steam, they would have landed at $77.4 billion. They would be about 15% up from where they landed in 2019. So now let's just think about how all that might roll into today's stock price. And where I'm going to start with is on the historical valuations for Disney stock. So if we scroll back to 2015, we can see that the forward PE in 2015 through 2020 actually looks like we should drop 2020 because of the pandemic and how that affected things. But you basically had a forward PE between 15 and 21. So for purposes of this video, let's just say it's a 17 average on the forward PE, knowing of course that we are still in a very low interest rate environment regardless of what the Fed does through the rest of the year. All right, so we identified a potential reasonable forward PE of 17. Depending on your outlook. I think that valuations are going to contract a little bit. That's why I chose the time frame that I did from 2015 through 2019. It was also a period of rising interest rates. So to me, it felt like a good guess, right? If you're more bullish and you think that multiples expand, perhaps you think that Disney, their growth story constitutes a higher multiple, you might land in the 20s or 25 or something like that. That's all opinion. But now let's go into Seeking Alpha and see how earnings are trending as of today. And the first thing I want to call out is September of 2019, where the actual EPS for the year was $5.77, right? So remember, 2019 represents the last full year prior to the pandemic that parks were at full operation. Now, on the flip side of that, there was no Disney Plus at that time, which I believe came out in June or July of 2020. So you had parks running at full bore, but you had no Disney Plus. I guess they did have Hulu and ESPN at that time, but suffice to say they've made some significant contributions to that streaming library. All right, so 577 in 2019. If all goes well this year, according to analysts, $4.06 on the EPS side. Now, if you were going to take 406 times 17, your share price would land at about $70. That's about 50% down from where we are today. I'm not saying that that's a fair value for Disney right now. I'm more concerned about the long term, looking ahead. So notably, next fiscal year, which by the way, since it starts on October 1st of this year, so call it 6 or 7 months from now, you're going to be using the 2023 EPS. Right now, that comes in at 554 on analyst estimates. That's 36% growth from this year that we're in now. That is also much closer than the 2019 EPS of 577. I do feel relatively good about projecting a $6 EPS just from having a full year of park operations in fiscal year 2023. By the way, quick pause, I should call out this platform here, Seeking Alpha, that I use a lot on my channel if you're just stopping by for the first time. And there is a significant discount on a 1-year subscription down in my description. So check that out if you're interested in learning about Seeking Alpha Premium. Phenomenal deal, tons of data. I use it all the time. And if you're interested in supporting the channel, that is my affiliate link down there in the description. So I do receive a commission, but I think you will find this is a very valuable platform. All right, so I said round up to $6 EPS and put in a forward PE of 17. Get a share price of $102. So if you're looking for like the rock solid value deal, then I would say $102 is probably fair. Okay, now on the flip side of that, let's say you bump that forward PE up to 20 in anticipation that Disney uses 2023 as their next launch cycle, right? They're finally digging out of the COVID concerns and they start growing like a weed. So you throw a 20 or maybe even a 25 if you want to get crazy on it, but a 20x of a $6 EPS puts the share price at $120. So in my opinion, at 140, you're probably still a little overpriced for the reasonable outlook. All right, guys, so if I was throwing darts, you're looking for Disney at 120. I mean, 102 is the for sure, in my opinion, but who knows if you'll ever see that. Now, if you own Disney at 140, some of the good things that could happen is EPS estimates blow through the roof. And I think that parks getting back to full-scale operations has that potential. They're not going to be as profitable as they were in 2018, 2019, because now you have a whole bunch of new sanitization rules, extra staff, things like that. But in the long run, it makes sense that Disney would continue to find new ways to extract profits out of the parks. All right, guys, so that's my take on Disney stock looking ahead to 2022, 2023. Let me know what you think about this one in the comments. Don't forget to check out that special offer on Seeking Alpha in the description. And as always, if you enjoyed the video, please give it a like, tell all your friends. We'll see you on the next one.